On August 5, 2024, one central bank raised interest rates by 0.25%. Within 48 hours, the Japanese stock market had its worst day since 1987. Global equities crashed, Bitcoin dropped 20%, and most people watching their portfolios collapse had no idea why. The answer wasn't in America. It was in a trade most people have never heard of. The dangerous part is, this trade is still running, and it's bigger now than it ever was before the crash. At its most visible level, the yen carry trade is about $500 billion in active speculative positions, borrowed in Japan, invested in US stocks, bonds, emerging markets, real estate, anywhere with higher returns than Japan offers. But beneath that is something much larger. Japan is the world's biggest net creditor nation. It holds $3.7 trillion in foreign assets, much of it funded by decades of cheap yen. And those assets connect the Tokyo money market to every financial market on Earth, which means when Japan changes its interest rate policy, the world moves. So when did the world's financial system become dependent on Japan's near-zero interest rates? And what actually happens step by step when that changes? Because once you understand how this trade works, the August 2024 crash makes perfect sense, and you'll understand why the next one could be worse. To understand it, you have to go back to Japan in the 1980s. Japan's economy was the envy of the world. Its companies dominated global manufacturing. Its land was worth more than the entire United States combined. Then, in 1990, it all collapsed. Economist Richard Werner spent years inside Japan's financial establishment, eventually publishing what became a bestseller in Japan, Princes of the Yen. His conclusion was stark. The Bank of Japan hadn't failed to prevent the crash. It had quietly caused it, through secret directives to commercial banks called window guidance that steered credit into real estate speculation, inflated the bubble, and then choked the lending that kept it alive. The consequence lasted 30 years. Japan entered a deflationary spiral with interest rates at or near zero for 3 decades, and, in doing so, accidentally or by design, it created the conditions for the most dangerous trade in modern finance. The logic is brutally simple. If you can borrow money at 0% and invest it somewhere that earns 5%, you pocket the difference. That's the carry trade. And for 30 years, Japan offered exactly that. Near zero interest rates, a stable currency, essentially free money, if you knew how to access it. Hedge funds borrowed yen. Banks borrowed yen. Insurance companies, pension funds, trading houses, all of them borrowed yen and deployed it into US Treasury bonds, American tech stocks, emerging market debt, real estate in cities around the world. The trade was so reliable and so consistent that it became a foundation of the global financial system, not a speculation, infrastructure. What most people miss is this. As economist Jeff Snyder has documented extensively, it wasn't just speculators. Japanese banks themselves became a major provider of dollar liquidity to the global financial system, swapping their excess yen into dollars through derivatives markets. The yen carry trade wasn't just funding investment, it was helping fund global trade. Here's where it stops being a currency story and becomes a system. A Japanese bank, or a hedge fund, or an insurance company borrows yen at near zero cost. They swap that yen into dollars, and those dollars flow into US tech stocks, into treasury bonds, into Brazilian real estate, into Indonesian government debt, into any asset anywhere on Earth that earns more than Japan offers. The money earns its return, the yen loan gets repaid, the spread is pocketed. And because this trade is so reliable, investors don't just do it with money they have, they borrow more, they lever up. Because when the trade works, and for 30 years it almost always worked, leverage multiplies the profit. The entire chain takes minutes to execute. The positions sit open for months, sometimes even years, which means trillions of dollars of global asset prices are, at any given moment, quietly supported by cheap Japanese borrowing costs. Now, here's the fragile part. The whole thing only works as long as 3 conditions hold. 1. Japanese interest rates stay low. 2. The yen stays weak or stable. 3. Global markets stay calm. Break any one of those 3 conditions, and now the chain runs in reverse. If the Bank of Japan raises rates even slightly, borrowing yen becomes more expensive. The less trade becomes less profitable. If the yen starts to strengthen, as it does when rates rise, it gets worse. Now you're paying back a loan in a currency that's worth more than when you borrowed it. At that point, investors don't exit gracefully. They get margin calls. They have to sell their US stocks, their bonds, their emerging market positions, sell everything to raise dollars to repay yen. And when they sell everything at once, prices drop, which triggers more margin calls, which triggers more selling. The chain doesn't slow down. It snaps. And what makes it truly dangerous is the scale. This isn't one trader or one fund. It's a synchronized global deleveraging. Trillions of dollars of positions built over decades, all trying to exit the same door at the same moment. Let's put real numbers on it. Japan's net overseas assets hit an all-time high in 2024, 3.7 trillion. That's money Japan has lent, invested, or deployed outside its borders, much of it yen-funded. Morgan Stanley estimates roughly 500 billion in active speculative carry positions remain open today, after August 2024's partial unwind. Meanwhile, Japan's long-term bond yields are at their highest levels in decades. The 30-year Japanese government bond recently hit yields not seen in generations. Here's why that matters. When Japanese bond yields rise, domestic assets become more attractive relative to foreign ones. Japanese pensions, funds, and insurance companies, which hold enormous foreign asset portfolios, begin asking, why take the currency risk of holding foreign bonds when Japan now offers reasonable yields at home? The answer to that question, if enough institutions change their mind simultaneously, is repatriation. Capital coming home. And that's not a speculative trade unwinding. That's a structural reversal of 30 years of capital flows. And the dangerous part is, we've already seen this system snap. Once. On July 31st, 2024, the Bank of Japan raised its interest rate from 0.1% to 0.25%, a quarter of a percent. By any measure, a small move. 2 days later, US jobs data came in weak. The rate differential between the US and Japan began narrowing. On August 5, 2024, the Nikkei fell 12% in a single day, its worst session since Black Monday, 1987. The S&P 500 fell 3%. Bitcoin dropped from $62,000 to $50,000 in 48 hours. The VIX, the market's fear gauge, spiked over 60, a level it had only exceeded during the 2008 financial crisis and the COVID crash. All of it from 1 quarter-point rate hike in Tokyo. The part that should concern you is this. As Michael Gade of the Lead Lag Report put it, you don't unwind something that's been building for decades in 2 days. The August 2024 episode didn't resolve the trade. It didn't clear the positions. It showed us what the first tremor looks like. The BOJ has continued hiking. Rates are now at 0.75%, the highest since the mid-1990s, and every hike tightens the same spring that snapped last August. So why does this matter to someone who's never borrowed a yen in their life? Because this trade isn't just sitting on hedge funds. It's woven into the price of your mortgage, the yield on US Treasuries, the valuation of your 401k. Japan is one of the largest foreign holders of US government bonds. If Japanese institutions start selling treasuries to repatriate capital, US bond yields rise. And when US bond yields rise, mortgage rates rise. Corporate borrowing costs rise. The discount rate on every stock rises, meaning stock prices begin to fall. Lynn Alden has framed it this way. Japan's normalization is one of the few forces large enough to tighten global financial conditions independently of what the Federal Reserve decides to do. The Fed can cut rates. If Japan simultaneously repatriates trillions in capital, the net effect on global liquidity could still be tightening. In other words, the Fed's tools may not be enough to offset what Tokyo controls. And here's where it stops being a finance story. The Bank of Japan didn't get to net zero rates by accident. As Richard Werner documented, it was the result of decades of deliberate policy, a central bank engineering its economy and in doing so exporting a hidden subsidy to global markets. Now, the BOJ is trying to exit, slowly, carefully, but exit is exit. Every time a central bank that has held rates near zero for 30 years raises them, it is unwinding 30 years of embedded leverage in the global system. Leverage that nobody fully mapped, leverage that nobody fully controls. And the global financial system, as it was built, assumed Japan would stay cheap forever. That assumption is ending 1/4 point at a time. The trade doesn't slow down, it unwinds, and there's one variable that tells you how close we are. The spread between US interest rates and Japanese interest rates. That gap is what makes the trade profitable. Every time the BOJ hikes, the gap narrows. Every time the Fed cuts, the gap narrows further. Watch that spread. When it closes enough that the trade stops paying, the spring releases, and by the time most people understand what's happening to their portfolios, their mortgage rates, their retirement accounts, it's already too late to matter.